Thanks, Laurie, for inviting me here. And again, I think it's a great forum. Let me tell you a little bit, just for 1 second before I begin the specifics of the talk, about kind of an overview of my research interests. I'm interested in the broad intersection between macroeconomics and finance. By the way, I teach the FlexCore macro course. I see a few familiar faces here, and for those of you who are going to be taking it, I'll be teaching it again in a few weeks. So I'm interested in this broad intersection between macro and finance. Done work on consumer spending and saving. I'm doing work on Social Security. I'll talk about some of that today. Some work on private pensions, and broadly about hedging macroeconomic risks with financial assets. I've also done some work on household and consumer finance, and just finished teaching a course on psychology and economics of consumer finance as well. So these are some of my research interests. The question I'm going to talk about today is about valuing risky cash flows. You're all familiar with valuing risky cash flows in finance when you take your basic finance courses and advanced finance courses. But I'm going to talk about it more in a macro context. Okay, so how do we come up with the appropriate discount rate for valuing cash flows? Well, a standard model that you all learn is to compute some risk-adjusted discount rate for cash flows, right? You compute the market risk, maybe in a simple model, a CAPM model, you take a beta of the cash flows, and then you use some asset pricing model to come up with the right discount rate. And of course, the higher the beta of the cash flows, right? The higher the covariance with the market, the greater the appropriate discount rate. So what I'm going to do is ask the question: how should governments discount future tax flows, future cash flows, future taxes, and future revenues? And should it use a similar technique as what we use in corporate finance? And I'm going to address this question. It's kind of a broad question, but I'm going to address it specifically by focusing on the U.S. Social Security system. So let me tell you a little bit of background. The Social Security system is one that's gotten a lot of attention in the last few years. This from last week, where President Obama said that we have to find a bipartisan solution to strengthen Social Security for future generations without putting at risk current retirees, the most vulnerable people with disabilities, and without subjecting Americans' guaranteed retirement income to the whims of the stock market. That last quote is a reference to the Social Security, the proposed attempt by President Bush in 2005 to privatize Social Security, or create a system of personal accounts. That's separately is a topic I'm quite interested in and have done some work on as well. So some of the questions that come up thinking about Social Security is, first of all, how healthy is the U.S. Social Security system? And one measure of health relates to present value of those cash flows. So one question that's key is, what kind of discount rate should be used to measure those future cash flows? And that's what I'm going to focus on. Second is, how large an increase in taxes? I'm going to tell you, by the way, as do others, that the Social Security system is a bit out of balance and is in need of some changes. But how large an increase in taxes would it take to restore that Social Security balance? And the third thing along those lines is, would it save money to change the nature of the way the Social Security system is structured, to shift from, instead of indexing to wages, to index to prices? I'll tell you a little bit about what that means and ask the question of whether or not that would save money. So it turns out that the answers to all these questions depend on how we treat risk in macroeconomic variables, and in particular one macroeconomic variable, which is wages, salaries. So the key issues that come up here is, how much uncertainty is there about the path of future wages, and how does that uncertainty vary with horizon? Differ over short horizons versus long horizons. And second, how correlated are wages with factors that determine asset prices? Because that's going to be key. So things like the overall stock market, aggregate consumer spending, and how does that correlation vary with horizon? Okay, so these are going to be some of the key things we need to understand in order to do this discounting. So I'm going to draw on this talk on one paper specifically that I'm doing with John Giannakopoulos called The Market Value of Social Security. But there are also some other papers that are related to this, including some work on reforming Social Security with a certain kind of personal accounts. And these are all available at, whoops, I forgot to add the website, but at my website, okay? So.
And again, you'll be able to link these directly to the Program for Financial Studies website. You can click on it every March.
Thanks. Okay, so a quick intro into the future Social Security cash flows. These are the standard numbers presented by the actuaries about Social Security, ranging from 2000 out to 2035. The red line is the income of the program, excluding any interest payments on the trust fund. The blue line is total income, which includes interest payments on the trust fund. There's a debate as to how real that trust fund is, but we're not going to deal with that right now. And the green line is the projected outflows. So what do you see here? You see that up until recently, we've been running surpluses by whatever measure you choose, whether you compare outflows to income excluding interest or outflows to total income. We've been running surpluses. So why is there all this talk about problems with Social Security when we've in fact been running surpluses? Well, the answer is that those lines crossed and are crossing. And they crossed here a little bit and are projected to stay about the same, but then really diverge for a while if you exclude the interest income. But even including the interest income, they cross out here at this period where the outflows match the total income. We're talking about a little after 2020, and at that point we start running cash flow deficits, and it's not just for a few years, but they're projected to get even bigger. Okay, so that's one way of looking at it. The second way of looking at it is to look at the accumulated trust fund. And here it is. This is the path of the accumulated trust fund. We're sitting now at about $2.5 trillion in the trust fund. And it's projected to rise. These are in constant dollars, $2009. It's expected to rise for a while. But then around the time that the cash flows flip, it starts declining. And right around 2037, which, what year are you guys going to be retiring? A little after that, right? You'll see it's projected to hit zero and then keep going downward. So it's exhausted 2037, but the good news is the future cash flows are still projected to cover about 75% of projected benefits. So even if we do nothing on Social Security, which I don't think we should do nothing, but even if we were to do nothing, we'd still be able to cover 3/4 of the cash flows. So it's not as bad as sometimes it's presented that it'll literally be nothing after that. So the actuaries at Social Security have computed some cash flow measures, some solvency measures, where they look at present values of future flows. And there are 3 different measures, and I'm not going to go into too much detail about what they are, but one of them is, how much would it cost today if we just shut down the system? How much would we be short? If you just look at what's been accrued to date and promised to date in terms of benefits based on work experience up until now versus what's in the trust fund, well, they come up a little short, 18.9 trillion. Okay, so just even our total national debt, this is an implicit debt. Our total explicit debt is far less than this, right? So this is much bigger than our total explicit debt, even though that's gotten big in recent years. Others have argued that maybe that's not the best measure to use, that there's something called a closed group transition cost that includes some of the future members as well, or an open group obligation. This 75-year one just takes all the cash flows for 75 years. That's only 5 trillion, and the infinite horizon one is 15 trillion. That's if you kind of go on forever. So, but the key idea is that they're trying to compute present value measures of this system. And here's what a graphical representation that we did of these cash flows. Here's those yellow cash flows are all the ones that have accrued, that everybody's earned already. So for those of you who had a job prior to coming here, you made Social Security payment in the US, you made Social Security payments, you accrued a small amount of benefits, you're part of that yellow line, cash flows, okay? You won't be collecting them until out here, so you're part of those cash flows in here. Then there are the current workers' benefits accrued in the future. So this is what you're going to accrue after you get your next job. And this green line up here are the taxes that you're going to be paying after you get your next job. And then out here are the future workers' taxes and the future workers' benefits. So those are the people who are now 15 when they start working, what they're going to accrue. So this is a schematic, a color schematic of all the future cash flows. And the actuaries discount these cash flows to get back to the present. In addition to talking about these cash flows, we're going to talk about a proposed policy change. And I'll come back to that in detail in a minute, this wage indexing versus price indexing. So what's the roadmap of how we proceed in the paper? Well, we argue that future Social Security inflows and outflows depend on wages. Okay? We argue that wages are random, they're stochastic, and they're correlated over long horizons with things like the stock market and other asset pricing fundamentals. In other words, if the economy does well over the next 30 years, chances are wages are going to be high, and chances are the stock market's going to be high. On the other hand, if the economy goes and does not do well over the next 30 years on average, chances are wages are going to be lower and the stock market's going to be lower. So there's this long-run correlation. Now, assets with payoffs that are directly tied to wages or even to GDP are not currently traded in financial markets. We can't go out there and trade GDP bonds or wage bonds. But in principle, those could be created, and we argue that it would be helpful to create some financial securities like those. But nevertheless, we could estimate what the prices and implied discount rate would be if they were traded. So we can imagine, suppose these things were traded, how would we figure out pricing them? Right? Imagine you worked for a firm and all of a sudden the government announced that they were going to issue these bonds, but they hadn't yet been issued. How would you go figuring out how to price them? And that's what we're going to do. So we're going to come up with a model. Since we don't have real prices to use because they aren't traded, we're going to come up with a model of how to price them. And once we have that model, then we're going to go back to these cash flows and say these represent implicit positions in wage bonds, long and short positions in wage bonds. And so we can use the prices of wage bonds or the implied discount rate in those wage bonds to back out present value measures. So that's where we're headed in this paper. So the question is, why market value? Why not use what the actuaries do, which is just basically take the expected value of cash flows and discount it back at some riskless rate? Well, we argue that doesn't appropriately adjust for risk. In particular, these market value measures that we compute answer the question, how much would governments need to pay financial markets today to balance the system? In other words, to absorb the difference between all inflows and outflows. Okay, we're facing a shortfall. If we just paid financial markets to cover all the gaps but absorb all the positive amounts, the surpluses as well, what would it cost? Okay, and that's what we're trying to get at, rather than just kind of an expected value approach. And we argue that by doing that, we're treating non-traded future cash flows, things like taxes and benefits, similar to traded assets like stocks and bonds. If we were going to value a stock, we wouldn't just take the expected value of the cash flows and discount back at the riskless rate. We would have to do some risk adjustment. So Social Security, the taxes and benefits are linked, as I said, to the average wages. Right? So how much you pay depends on your wages. How much you receive depends on your wage history, but it also, through the intricacies of the system that I'm not going to go into in detail, but through the intricacies of the system, are linked to what the economy-wide average wage is in the year that people turn 60. So if it turns out that wages in the economy, not your own, but wages in the economy are high 60 years from now, everybody gets more benefits throughout retirement. If it turns out that they're lower, everybody gets less benefits. So this is a program rule that ties benefits to wages, and that's going to be key to the valuation here. So what do we do to define the discount rate? We define a wage bond, and a wage bond, a whole term structure of a whole set of different maturity wage bonds that are J periods long. So a 1-year wage bond, a 10-year wage bond, a 20-year wage bond. Each one pays out a single lump sum payment, which is the amount of aggregate wages or average wages J years from now. Okay, so we have a whole maturity structure of these wage bonds. And we're going to figure out what the rates are going to be, as I mentioned. So how are we going to price these wage bonds, since they're not traded now? 2 ways. One is we write down a little simple macro model. It's called a general equilibrium macro model. And we solve for what the wage bond prices should be in the model. So I'm not going to go into the details of that, but that's one approach. And the second is a reduced form model linking wages and stock prices. So we just write down an equation that we think characterizes this relationship between wages and stock prices. And then we use risk-neutral pricing. Basically, we price the wage bond as a derivative on the stock market. So for those of you who've taken derivative pricing, things like that, we essentially do the same technique for this asset and say, what should it be worth based on this model of connecting these things. So in both these models, wages and stock prices are not correlated in the short run. In the data, wages move up and down in ways that are unrelated, and the stock market moves up and down in ways that are unrelated. but we argue that they're strongly correlated in the long run, and so we build that into the model. And then we solve for wage bond prices using the kind of actuarial approach, and then we solve for it using the market approach, our approach, and take the ratio and come up with an implied discount rate. So what do we get for results when we do that? Well, this is for the excess return. Okay, this is the discount rate for wage bonds relative to the risk-free rate. So this is the risk adjustment that comes out of the model. The standard actuarial approach, as I've drawn down here, has a 0 risk premium. Okay, so it's just, but our model, there are a couple things that we learned from this. First of all, there's a positive risk adjustment. Okay, so we have to use a higher discount rate when doing this. And second, it's not a flat term structure. Okay, it's actually an increasing term structure. Why is the increasing term structure? Because these things are not very correlated in the short run, and therefore for short run cash flows, there's not much risk in them. But they're highly correlated over long periods of time, like 30, 40 years, and therefore we have to use a much higher discount rate for those long period cash flows. So in models, by the way, that focus only on the short run correlation, they just run an annual correlation on these things and do a beta, and some authors have done this. They just sort of run a single period beta model where you regress wages on stock returns. You get almost nothing, and it suggests there shouldn't be risk adjustment, when in fact there should. Okay, so that's the first step, is come up with the pricing. The second step is to apply this to Social Security, and for that, we take these cash flows, and any money that's coming in by the government, that's like a long position in wage bonds. And anything that's benefits to be paid out by the government is like a short position in these wage bonds. Okay? So we translate this picture that I showed you into positions in wage bonds. Okay? So the ones out here are like a position. This is long, this is short. Then we net those out and show you when we apply the adjustment and the risk adjustment, what do we get? And so this is the actuarial approach. This shows you that we're short under this measure. The government is short wage bonds all this way. But when we apply the pricing, the market pricing to it, it shows, because we're using a higher discount rate, that short position isn't as expensive for the government. So when you take the present value, which is just basically adding up all the area under the line, you find that there's the values, the deficits that on a present value basis are actually less than what the government typically reports, because these are risky cash flows. And same thing for this other measure, this closed group measure. We can show that it's less, and also under the infinite horizon open group measure, basically cash flows that occur 50 years from now we don't even have to worry about under our measure, because there's the risk adjustment is so large and the discount rate is so large that it basically is irrelevant. So what do we conclude from this? The risk adjustment leads to smaller deficits, various ranges depending on which one we're looking at. But the deficits are not as large on a present value as we think. Last thing is wage indexing versus price indexing. That some people have argued, because wages are expected to grow faster than prices, if we switched to a price index system instead of a wage index system, we'd save money. Okay? And we argue that, in fact, that's not true. That it turns out in this model that even though wages are expected to grow faster than prices, the risk is such that it's actually cheaper to index to wages. And what's the intuition behind that? Well, the intuition is that there are states of the world in which real wages are going to be much lower in the future. And chances are they're going to be higher, but there are states of the world in which they're going to be lower. And in those states of the world are the states of the world where the economy has tanked and where people are going to really value an extra dollar. So the government it might seem like it's saving money by promising to index to wages instead of prices instead of wages, but in fact, on a risk-adjusted basis, it's not cheaper. In fact, it's cheaper to do prices rather than wages. So conclusions: the market or risk-corrected valuation differs from standard practice and has important implications for measuring solvency and evaluating policy changes. And it's actually relatively easy to implement once you've written down the model to actually implement this in practice. The next steps are to additional research and to enhance and calibrate these macro models of wage risk, to do some empirical estimates of what the uncertainty is in wages over really long horizons. And you need lots of long-run data to do that. to encourage governments to issue or facilitate private sector issuance of wage bonds or GDP bonds, longevity bonds, which is another piece of the risk, and also long maturity TIPS, which we argue are important as well to extend out the maturity structure of TIPS, and to encourage governments to adopt this approach. And last slide, other potential applications of this approach include social security systems in other countries where a lot of the same issues come up about wages and imbalances. It's also applicable to define benefit pensions and asset allocation, to the overall government taxes and revenues, basically the overall fiscal risk situation. We want to do it. Governments just don't do these things on a risk-adjusted basis. And finally, any corporate cash flows that are tied to macro variables. If you're trying to discount out a project and it's many years ago and the cash flows are tied to wages or GDP or other kind of variables, you want to take into account this long run risk. So let me stop here, and thanks very much.